Anurag, what is your view on the demand for Indian government bonds and their yields following inclusion in FTSE Russell's index after earlier inclusion by JP Morgan and Bloomberg? Also, which part of the curve will be benefited with this inclusion?
Right. So that's a very important point, Sonal. Thanks for asking that. So FTSE Russell, included India in its latest review in the month of October, and as a result of that, FTSE Russell has included India in the emerging market government bond index. So the data on the AUM tracking the emerging market government bond index is slightly still, I would say, quite muddy, but market expectations is that it should be about 40 to 50 billion. So assuming that India will get a weight of 9.9%, sorry, close to 9.1%, we expect India to have or to experience a flow of 4 to 5 billion, assuming the passive investors decide to fully replicate the benchmark. But more importantly, the index inclusion is happening from the month of September 2025. So it's still some time away. So probably we expect those flows to come, close to the index inclusion date, and hence we do not really see an immediate impact as far as the flows are concerned. But given that now India is included in the JP Morgan, emerging market bond index, India is now included in the Bloomberg emerging market bond index, as well as now FTSE Russell emerging market bond index. This overall, paves the way for India to even enter into other aggregate global indices, which can have a meaningful impact on flows to India. Also, it also puts Indian bonds on the radar of many foreign investors who are not looking at India as an emerging market, from a debt perspective. I mean, of course, they were looking at India from an equity perspective, but India was not really seen very seriously from a debt perspective so far. But I think with inclusion of India in all these indices, now foreign investors are looking at India very seriously. One of the benefits of India is also, apart from our, a very strong fiscal consolidation roadmap, is also our FX reserves of 700 billion, which is keeping our currency quite, stable, and which foreign investors typically tend to prefer. So they typically tend to prefer in stable and lower volatile currency. So I think even the investors who are looking at funds actively, even active investors would possibly now looking at India and its overall, quite positive for demand supply in the medium term. As far as which part of the yield curve is, the most attractive, it totally depends on one's investment horizon. So if one is looking at a more medium term view, which is, let's say, more than 12 months plus, investors should be allocating to, let's say, moderate duration funds, which are giving them reasonable duration between 3 to 4 year AAA part of the yield curve. If investors have a more than 3 year plus kind of investment horizon, then they can consider gilt funds and long duration funds, which typically carry slightly more aggressive duration. But of course, they come with slightly higher volatility as well. But given that we are in the, just starting with the interest rate cut cycle, probably investors who have a slightly longer term horizon can consider allocation to these strategies as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.